My name is Jake, welcome to the channel, and today's video I want to compare two dividend growth ETFs in DGRW and DGRO. These are two ETFs that I think a lot of people have probably heard about, but maybe don't fully understand the differences, and in today's video I'm going to walk you through step by step everything, and I mean everything, that you would need to know when it comes to investing into ETFs like these. If you're new to the channel, once again, my name is Jake. I retired at the age of 37 from my 9-to-5 job here this year in 2023. 2 weeks ago, I created a video called The Simple Path to Wealth with Dividend Investing. In this video, I broke down the topic around how to invest in the simple path to wealth with dividend investing using primarily two different ETFs. And those ETFs are SCHD and DGRO. In my opinion, if you want to be a dividend investor and you want to retire off of your dividend portfolio, but you don't want to invest in individual stocks, this is a great way to focus on building a dividend portfolio. Now, in my opinion, I like that, but also if you want to add individual companies or other ETFs, I talk a lot about the core and satellite approach to investing. In this video right here, I break down, in my opinion, the different ways that a new investor could start a dividend portfolio in a very simple and easy way. One of the questions that I saw over and over from this video and from videos that I've made in the past is, well, what's the difference between DGRO and DGRW? Why would I want this one versus the other one? And in this video today, I'm going to break down and share with you the differences between these two ETFs. I'm really excited about this video because I love talking about these two ETFs, and I hope that you're as excited as I am about today's video. But just in case, if you're having a bad day, just remember that there's always someone out there who's having a worse day than you, and it could look a little like this.
Acá andamos batallando de este lado, cumple el sueño americano y no crean que está tan pelado como me la habían contado. Voy de la...
Oh, shit! Are you all right? No. Get the dog, hurry up, get the dog. No, don't make a scene. Get the dog.
Oh my gosh, I love it. I love it. So to start off, we're going to do a deep dive into DGRO, and at the end of the video, I'm going to do a side-by-side comparison of all the key metrics. So you can take a look at the fund profile here. The main thing that I look for is the fund methodology. What are you getting when you invest into this ETF? Because this is the meat and potatoes of the index. This is what you're investing in. Because at the end of the day, when you're investing into passive index funds, they're really just rule-based investments. Rule-based investments means that they're set up on specific parameters, and whatever those guidelines or parameters are for that index, that will be the outcome of the index. And that's very different than an actively managed index where a fund manager is actively picking what to buy and sell based off of a specific approach. Whatever the rules of the index, that's what you're getting. All right, so let's come back to DGRO and let's take a look at the individual holdings in DGRO. So if you look at the sector breakdown, you're going to see that healthcare is the largest weighting in this sector, in this ETF. You've got healthcare, financials, technology. The big difference between DGRO and DGRW is the weighting in technology. DGRW has almost double the weighting in technology right now. And if you look at the top 10 holdings in DGRO, you're going to see that Microsoft, Exxon, JP Morgan, Johnson & Johnson, Apple are the largest positions. But what you'll notice is the top 10 weighting, they're closer to around 2 to 3%. This is a big difference between DGRO and DGRW, is that the weighting in DGRO is capped much lower than in DGRW. Whereas at DGRW, it caps it at 7%. So you're getting more diversification with DGRO. And you might be thinking, well, that's okay, that's cool. And the thing is, it's all rule-based. The index is set up that way, and these ETFs function that way. Okay, does that make sense? And you as the investor, you don't have to do anything. All you're doing is you're investing in the rules of this index. That's it. So in total, there's 432 holdings, only 26% in the top 10 holdings. I really, really like this. Next one, another thing that I want to show you here really quick, and I'll talk about the dividends, the dividend growth at the very end when we do the side-by-side comparison. But here's something that I think is really, really cool. When you look at the dividend yield and you compare the yield on cost of DGRO. Now, DGRO has been around for about 9 years. So if you go to the middle of 2014, if you would have been buying since 2014, your initial yield on cost would be over 4%. 4%. Now, you might be thinking, well, Jake, it only has a dividend of 2.4%. Well, yeah, but if you would have been investing over the last 9 years, you would have an initial yield on cost since you started buying because of the growth of the dividend, you'd have about a 4% dividend yield. All right, next let's take a look at what is the fund methodology of DGRO. So let's take a look at it. So these are the rules of the US Dividend Growth Index from iShares. And let's take a look and see how this index is set up. So first off, the way that it works is this index looks at the total US market and it represents 97% of the market. Okay, 97% of the total US market. And then to be eligible to be included in this index, the rule is that REITs are excluded. Real estate investment trusts are excluded. Do you know what that means? This baby is 100% qualified. This is the best tax treatment that you can get in the United States. The best, absolutely creme de la creme. There's no REITs, it's 100% qualified. The yield, and what it does is indicated yield must not be in the top 10% of the dividend screen universe. You're not going to get a lot of shenanigans and BS, like a lot of hype in this index. All of that is excluded. Okay. Another thing here is that at least 5 years of consecutive dividend growth. Now, 5 years is not a long time. So the turnover you would expect to be a little bit higher in DGRO compared to SEHD. Okay. And others like Noble, the dividend aristocrats. So you're going to have a little bit more turnover, but actually not so much. It's not super crazy. So that's important to understand. And then the next thing here is that it has a positive consensus earnings forecast and a payout ratio less than 75%. So what this means is you're going to have not very many sin stocks, you're not going to have very many utility stocks, and not very many dividend yield traps because the payout ratio is at a healthy ratio. And then from there, the remaining stocks are targeted for inclusion and weighted in proportion to the value of their indicated dividend payments, subject to weighting constraints. And now this website alone doesn't tell you the weighting constraints. I'll show you that next. And then this index is reconstituted annually and rebalanced quarterly. Okay, so you're not going to have massive differences in, the weighting because it's rebalanced quarterly. Now, this part right here, you have to go and you have to find on a different website, and I did that for you, and it's right here, the Morningstar Dividend Growth Indices here. This is the portfolio construction. How it works is that the individual stocks are capped at 3%. So no individual company can be over 3%, and this is to improve diversification. This is a plus compared to DGRW, which caps it at 7%, and it's rebalanced annually. So DGRO rebalanced quarterly, DGRW rebalanced annually. Next, let's take a look at DGRW. This is the Wisdom Tree U.S. Quality Dividend Growth Fund. Index that it tracks is proprietary to Wisdom Tree. This is their own index. Whereas with DGRO, it was leaning on the Morningstar index, two different companies. Here, this is from its own company. And what we want to take a look at is we want to first look at the individual holdings. So let's take a look at it. So here, technology is at 29%. Now this is important because I'm going to reference this in a few minutes. The technology sector represents 29%. Now in the rule-based methodology of this index, it doesn't allow it to go over 25%. And so when they rebalance here in December, this will be trimmed down to 25%. Okay, because it's rebalanced annually, it's going over 25%. Okay, so just remember that. Okay, and you got consumer discretionary, industrials, healthcare, Both of these ETFs low in communication, utilities, energy. One difference that you will notice is there's a very, very small percentage to real estate. Okay, so it's not 100% qualified, but it's like 99% qualified. Okay, so almost 100%. Now, when we look at the top holdings, you got Microsoft, you got Apple, you got Johnson & Johnson. You see here that Microsoft is over 8.5%. Once it rebalances, it'll go back down to 7%. It will have to trim this and rebalance accordingly based off the market cap and other factors. Okay, so you got in the top 10, it represents about 36%. So more concentration, it's a little bit top heavy, and there's 300 holdings in this ETF. By comparison with SHD, for example, SHD has 100 companies. You're getting triple in terms of the number of companies. So this is how it's set up. I want to look at similarly like what we did before with the dividend yield and the dividend yield on cost. With this one, you're getting just under a 2% dividend yield. When you look at the 10-year yield on cost, if you've been buying this ETF for the last 10 years, your initial purchase 10 years ago would be yielding you just under 5%. This is the power of dividend growth investing. It's increasing your initial yield on cost as the dividend increases year over year. So if we take a look at the index and how it's set up, the Wisdom Tree US Quality Dividend Growth Index is a little bit different. And the way that it's different is it focuses on future metrics. Whereas with DGRO is looking at past performance and screening purely off of past performance. So do you understand that? Very, very different. Almost every ETF out there is going to be focused on historical past performance. DGRW is one of the only ones that screens for future growth potential. Okay, now that's one of the key differences, and it is very, very unique in that. So what this fund is looking at, when you invest in a DGRW, you're investing into companies that are included in this index that have at least a $2 billion market cap. There's 300 companies. It focuses on growth and quality factors. The growth factor ranking is based on long-term earnings growth expectations, not past performance, but expectations, while the quality factor ranking is based on a 3-year historical average for return of equity and return on assets. So it has a combination of future and past performance in their model, in the index. And the index is dividend weighted annually to reflect the proportionate share of the aggregate cash dividends each component company is projected to pay in the coming year based on the most recently declared dividend per share. So it's really focused on quality, both on a past and a forward-looking basis. Now, when you dig a little bit deeper and you look at the fund methodology, the way that it's set up is that the maximum weight of any individual company is capped at 7% and it's rebalanced annually. So the difference here, DGRO capped at 3% for individual companies, and with DGRW, it's capped at 7%. Okay, and then the next thing here is that the technology sector is also capped, and it's capped at 25%. And as I mentioned, right now it's right at about 30%, but here in December, that will be trimmed down to 25% as per the rules of this index. The real estate sector is capped at 10%, but as we saw in reality, it's actually only represents 1%. Now that may fluctuate a little bit, but I wouldn't expect too much fluctuation on real estate. It just doesn't represent a large enough market cap in the index. And then lastly, all other sectors are capped at 20%. This is to protect the investor so that there's no overweight in any individual sector or individual company, and it still maintains the survival of the fittest, whereas companies become more profitable and make up a larger percentage in the index. You as the investor passively benefit from that. And as companies become less innovative, less productive, less profitable, you as the investor don't have to do anything. Those companies will automatically represent less and less in the index each year. Okay, that is the beautiful thing about index investing. Now, the next thing here that I want to show before we do the side-by-side is the fund overlap. If you were to invest in the DGRO versus DGRW, or if you were to invest in both of them, does that make sense? And I want to do a few scenarios here, and I want to walk you through this. So if you were to invest into both DGRO and DGRW, you would have 56% fund overlap. And so it really begs the question, well, do you really need both of them? And in my opinion, it doesn't make sense having 50% of your portfolio DGRO and 50% DGRW. In my opinion, like I showed, here, let me show this really quick, in that other video that I made 2 weeks ago, when I talked about the simple path to wealth with dividend investing, and I shared different scenarios, there's different ways that you could set it up. In my opinion, DGRO and SEHD make up your core positions. But if you wanted to add additional companies or ETFs like DGRW, you could add them in a smaller percentage, but I don't think it makes sense to have them at 50-50. Now with SEHD and DGRO, absolutely it does, in my opinion. Let me show you a few different scenarios. So DGRO versus SEHD, the fund overlap is 28%. So not very much overlap. Now, if you were to do DGRW versus SEHD, you're getting very similar or comparable fund overlap. And so it begs the question, well, Jake, would it make sense to replace DGRO with DGRW? In my opinion, I don't think you could go wrong with either, but I personally prefer SEHD and DGRO and having DGRW as a satellite position. Here is the fundamental difference between these two ETFs. If you ever hear anything negative about DGRW, it just ultimately comes down to the expense. That's all it really is it is more expensive. It's about 3 times as expensive as DGRO. So you are paying a premium in terms of the expense ratio. And when you look at the performance of these, if you look at just the price return, this is the performance that you're going to see. This is without the dividend reinvested. But if you want it with the dividend reinvested, you go over here to total returns, and you can see the total return. DGRW has been actually outperforming DGRO. But here's the thing. When you zoom out, it's really only been outperforming in 2023. And if you believe in the reversion to the mean, meaning that markets are efficient and that they'll go back, kind of based off of historical trends, you could assume that this outperformance will have a reversion back to the mean. But I don't have a crystal ball. I don't know if that's going to continue, but it's just very interesting. You have to really squint your eyes to see the difference in performance up until 2023. Now, when you look at the ETF grades here from Seeking Alpha, you can see that they have very, very similar grades, right? Like DGRW across the board, great. DGRO across the board, great. Like these are not ETFs that are low quality speculative yield traps. Like this is the creme de la creme when it comes to dividend growth ETFs. When you look at the, let's take a look. Let's look at the dividends. So the 4-year dividend average has been fairly similar. This is what I like looking at as a dividend investor who's working a 9-to-5 job, because if you're dollar cost averaging in your portfolio, this is the percent that you want to look at. The forward dividend yield is really only important if you're lump sum investing, but for all of us, all other peasants out there like myself who dollar cost average their entire career, this is the reasonable dividend yield that you could expect on a go-forward basis that will also grow year over year in terms of your yield on cost. In terms of the 5-year dividend growth, they have comparable dividend growth, although DGRO has grown a bit more. But this week, Microsoft just declared a 10% dividend increase, and they make up the largest holding in this index. So I could imagine that this will increase with the Microsoft dividend increase. You can see here they have about the same, similar assets under management, though DGRO does have a bit more. The turnover, this is how frequent the companies in this index are turning over or changing once they rebalance. It's pretty high compared to like the S&P 500, but it's just something to keep an eye on. It doesn't really keep me up at night when I see that. So this is the side-by-side comparison of DGRO and DGRW. And in my opinion, like I said a little bit earlier, they're very similar. In my opinion, I like combining SCHD and DGRO as your core holdings, mostly because of the expense ratio. The expense ratio is just, it is pretty high in DGRW. But if you want to add DGRW as a core position in place of DGRO, that's okay. You can do it. I don't recommend it, but you can do it. I don't think you're going to necessarily break the bank by doing that. Okay. I personally much prefer adding DGRW as a satellite position, at a smaller percentage. And in my opinion, that's the way to go. When you have a simple approach like this, where you follow the simple path to wealth with dividend investing by investing into SHD and DGRO, and you follow the core and satellite approach, there's really not much you can do wrong if you're following these guidelines. There's a lot of things that you can do wrong if you're building a dividend portfolio just with individual stocks. Okay, there's a lot of things that you can do wrong. And if you're concerned about that, making mistakes and getting things wrong when building your portfolio, it's okay. You're not alone. I made an entire video on what most dividend investors get wrong. At the end of this video, I'll have that video pop up and you can watch that video next. Thank you so much, everybody, for watching the video. I hope that the video was helpful, and I'll see you all in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.